Imagine this. You're handed $10,000 and told to invest in stocks for 1 full year. The catch? Every decision you make could either double your money or cut it in half. Would you take the leap? Now picture this as your reality for 365 days straight. That's the journey I embarked on. And today, I'm sharing the most eye-opening lessons from this roller coaster year in the stock market. Stick around because whether you're a seasoned investor or a total beginner, these lessons could transform your approach to building wealth. Hi everyone, welcome back to Moneywise, the channel where we make finance, investing, and building wealth simple and accessible. Over the past year, I challenged myself to invest in stocks every single day, document my journey, and refine my strategies. From beginner mistakes to surprising victories, I've experienced it all. Today, I'll break down the key lessons that can help you avoid pitfalls, make better decisions, and build a strong portfolio. The power of starting small. When I first stepped into the stock market, it felt overwhelming, like diving into an ocean without knowing how to swim. I didn't know what to invest in or how much risk I could handle. Instead of freezing up, I started small. My first investment was $50 in an ETF tracking the S&P 500. It wasn't flashy, but it got me in the game. Starting small helped me overcome the fear of losing money. I quickly realized that you don't need a fortune to begin investing, just consistency. If you can set aside $100 or even $50 a month, you're already ahead of most people. The earlier you start, the more time your money has to grow, thanks to the magic of compounding. Risk management is key. One of the first stocks I bought was a tech company that was all over the news. Within weeks, it dropped by 30%, wiping out hundreds of dollars. That loss hurt, but it was a wake-up call. I had put too much of my portfolio into one stock. Over time, I built a portfolio that included large-cap stocks, small-cap growth companies, ETFs, and even a few bonds. Diversifying meant that no single loss could sink my entire portfolio. Another risk management tool I discovered was the stop-loss order. This automatically sells a stock if it drops below a certain price, protecting me from steep losses. Lesson learned. It's not just about how much you can gain, it's also about how much you're willing to lose. Emotions are your worst enemy. The stock market is like a roller coaster. It goes up, it goes down, and it'll make your stomach churn if you let it. In my early days, I let my emotions dictate my decisions. When the market dipped, I panicked and sold. When it soared, I rushed to buy more, often at inflated prices. The turning point came when I created an investing rulebook for myself. I committed to reviewing my portfolio only once a week and making decisions based on logic, not fear or greed. For example, if a stock fell, I'd ask, is the business fundamentally strong? Does it have long-term potential? If the answer was yes, I held on to it. Discipline saved me from impulsive mistakes and taught me a crucial truth. The stock market rewards patience, not panic. Research beats rumors. In my first few months, I fell for stock tips from friends and social media gurus. I bought into hype, thinking I was getting in on the next big thing. Spoiler alert, I wasn't. One of those hot tips cost me a 40% loss. From then on, I took research seriously. I started analyzing financial statements, understanding a company's business model, and looking at its long-term potential. For example, when I considered investing in a renewable energy company, I didn't just look at its stock price. I researched its revenue growth, debt levels, and competitive position in the industry. The time spent on due diligence always paid off. Remember, rumors might get you quick wins, but research builds wealth. One of the most rewarding parts of this journey was seeing the power of compound growth in action. Early on, I reinvested all my dividends automatically. At first, the extra shares seemed insignificant, but over months, those reinvested dividends started earning their own dividends, creating a snowball effect. Here's an example. I invested in a dividend-paying ETF that yielded about 3% annually. By reinvesting those dividends, my total returns were higher than I'd initially expected. Over time, this compounding effect can lead to exponential growth, especially if you stay invested for decades. Losses are part of the game. One of the hardest lessons to accept was this: not every investment will be a winner. During my 365 days, I made mistakes, chasing hype, holding on to losing stocks for too long, and overtrading. At first, every loss felt like a failure. But here's the truth. Every great investor has losses. The key is to treat them as tuition for your financial education. Each loss taught me something new, whether it was about timing, diversification, or understanding market cycles. Instead of fearing losses, I started embracing them as opportunities to improve. Patience pays off. Some of my best performing stocks didn't show any significant gains for months. One company in particular was flat for half the year before suddenly surging 50% in value. If I had sold early, I would have missed out on those gains. The stock market isn't a get-rich-quick scheme. It's more like planting a tree. You water it, give it sunlight, and let time do the rest. The longer you stay invested, the greater your chances of success. Keep learning and adapting. The stock market is always evolving. Industries rise and fall, technologies change, and market trends shift. Over the past year, I made it a point to keep learning. I read books, followed expert investors, and even took a few online courses on financial analysis. This constant learning helped me adapt my strategies and stay ahead of the curve. For example, I started the year focusing solely on individual stocks. By the end, I had a more balanced approach, incorporating ETFs and other asset classes for stability. What you should take away. So, after 365 days of investing, what's the biggest takeaway? Investing isn't just about growing your money, it's about growing your mindset. Start small, stay disciplined, and keep learning. The stock market will test your patience and your emotions, but with the right strategy, it can be one of the most powerful tools for building long-term wealth. If you're hesitant to start, remember this. The best time to plant a tree was 20 years ago. The second best time is today. If you enjoyed this video, don't forget to like, share, and subscribe to Moneywise for more practical tips on investing and personal finance. Have you started your investing journey? Share your experiences in the comments below. Let's build wealth together, one step at a time.